Hi, Larry Gaines, Power Cycle Trading. In this video, I'm going to show you two very different but very defined risk and great upside returns, different option strategies. So the first one will be, this is a directional option trading strategy, and this is on Lamb Research. So we're just getting a breakout here today. This is what we call a volatility squeeze. So we're getting a breakout for potential, really powerful move in this direction to the upside based on our indicators, momentum, etc. So one of the really great ways to trade this, which is very defined risk, good leverage, is to do what we call the call debit spread. So here's that trade setup, and here's potential risk reward on that particular spread trade setup. This trade that I'll show you is basically a call debit spread, or with the combination of a bear call credit spread together, and that creates what we call a call condor. So this is what we call a call condor. So basically it's combining a call debit spread. So we bought the 212.5, 215 November 24 series call debit spread, paid $95. And then this started to push up, so we hedged out part of that trade by selling the 220, 222.5 bear call credit spread. When you combine those two together, you end up with a call debit spread here, 212.5, 215, and then a bear call credit spread here, 220, 222.5. We're risking then $55 to the downside, $55 to the upside. If it closes here next Friday, not tomorrow, but a week from tomorrow, on the 24th, I guess, this would make $195. So your risk is $55 to make $195, so that's over 300% return. Now this next option strategy, this is on Facebook, and this is what we call a delta neutral. So we're not looking, or a directional neutral, we're not looking for any primary direction. We're actually looking for a little bit of direction. We're looking for Facebook to move up to around 180. So it's currently close to being there right now. So this is for an expiration trade tomorrow on a monthly option expiration. So within a monthly option expiration, or any expiration, if you get the pin or the strike just right as far as where it goes out, in this situation we're looking for 180, then this trade takes advantage of volatility collapse going to zero, and implied volatility going to zero, and then time decay going to zero. So this is what we call an iron butterfly. So we set this up today. This is then an iron butterfly, so we're basically selling the 180 call, buying a 182.5, and then selling the 180 put, so sharing the same short strike, and buying the 177.5. Brought in $132 credit. You can see right now it's $103, so it's up a little bit, $28. But if this goes out theoretically tomorrow at 180, the max theoretical profit then would be your full credit received $132, your at risk is $118, so this would be over 100% return, and this is just a trade put on for one day. Hope you liked this video, and I'll talk to you on the next go around on my next video updates.